T-bill and chill might have been all the rage this year, but now the taxes are coming due. And for investors staring at some big capital gains bills, MUNIs offer a welcome tax-exempt alternative, particularly for those in the top brackets. Take this example. New York issued $1 billion in AA-rated 30-year debt last month, priced to yield at about 4.35%. But with tax adjustments, the wealthiest residents earn yields equivalent to 10% taxable debt, according to reports. So should you forget T-bills and move over to MUNIs? Jennifer Johnston is Director of Research for Franklin Templeton Fixed Income Muni Bond Group. So I'm guessing you're going to say yes, Jennifer.
Yes, I am going to say yes to that for sure. And there's actually a variety of reasons, some which we would always talk about, which is exactly what you're addressing, which is the tax advantage nature of the asset class in general, and the fact that you can get tax-free income, which, depending on your tax bracket, can result in absolute yields that really outperform other segments of the the other asset classes. And second, we feel pretty comfortable about the muni market from a credit fundamental standpoint. We think that they're good from a comparative basis to, corporate bonds, as an example. We tend to have lower default rates. So even in times of economic weakness, you can still feel pretty good about the credit quality of your investments as well.
And so, for some investors who are maybe not in the highest brackets, they might say, well, it's not as big a deal. I mean, is this really a strategy just for those who are wealthier?
So we think that anybody in any tax bracket can benefit from this. And then what we would look to in that situation is perhaps the tax advantage aspect isn't as powerful. But again, going back to the credit quality, to the fact that default rates are lower, and overall credit quality is actually higher than similar indexes, say, on the corporate side. Right. So we think it's a good diversification from a credit standpoint as well.
I don't know if you saw it today, but Ray Dalio made some comments along the lines of cash is great, but he wouldn't own bonds. And what would your response be to that, to those investors who, like him, are a little bit on the hawkish side of things still?
Sure. Well, we get a sense that there are quite a few people with money still on the sidelines, and we can't wait for them to jump into the muni market. But we think this is a great time to be in the fixed income asset class in general, even because rates are higher than they were 2 years ago. You're getting, perhaps up to 200 basis points more than you did 2 years ago. So to be able to capitalize on those higher rates, this is the time to do that. And to the extent that, the Fed is actively involved with trying to control inflation, we don't know how long this rate environment could last. So it might be time to jump in so that, you want to be at the head of that process. You don't want to be the last guy back into the asset class.
Do I have to worry New York is going to default?
No, you do not have to worry of all credits that New York is going to default. We feel pretty confident in general about credit quality. Coming out of the pandemic, that economic recovery, we have strong reserves and very strong management going into any kind of softness. We are seeing revenues to cities and states slow down a little bit. Again, those are driven by inflation. So as inflation is controlled, we're seeing revenues come down. But it's not to a level where we're concerned about municipalities, New York included, being able to find reserves or cut spending in order to manage a balanced budget.